Hello, I'm Steve Balls from Certa Financial Planning. I'm the Director of Wealth Management and Financial Planning, here to give you the monthly market update for November. Here are the 5 things we would like you to know. Our current positioning, the market corrects, GDP for quarter 3, the good, the bad, and the potential ugly. Is the Fed done hiking? And don't stop believing just yet in the Santa Claus rally. Here's our current positioning for the macro scales. With the recent pullbacks in the markets and an official correction happening, we still are in a neutral stance on the market trend. Fed policy continues to remain a weak negative, but with the recent data and recent comments out of the Fed for the November meeting, if a pause is here, we'll be shifting from weak negative to neutral. Fiscal policy, the government continues to spend and run deficits, so there's no change there as a weak positive continues to persist. We have had a downgrade to neutral from weak positive on the short-term outlook of the economy. That doesn't mean a recession is imminent. We're just looking at the data, and it seems that things are softening, some job losses, some unemployment. Things seem to be weakening. We're seeing to see some firings going on, unfortunately, and it seems like the short term is getting a little bit murkier. Long term, no change there. We still have a weak negative outlook as headwinds continue to persist. And then finally, we've had an upgrade here for valuations. U.S. large cap continues to be expensive, but small cap U.S. and the rest of the world has actually seen valuations come down to more attractive approaches that we're looking at right now. So slight upgrade from weak negative to neutral on valuations. Again, U.S. market, U.S. large cap market still expensive. U.S. small cap and the rest of the world is becoming more attractive. On October 27th, we had an official correction in the U.S. market, losing 10% from the highs back in July. Since then, though, we have rallied, so we'll see if that is a short-term trend or not. But just to be aware, market corrections happen almost every single year. They are very common. It doesn't mean that the market's going to finish negative for the year. Actually, that's quite the contrary. Typically, the market pulls back at once a year and finishes still positive majority of the time. Also, just because we have a correction doesn't mean a bear market's about to start. Since 1974, only 5 market corrections have become full-blown bear markets. Historically speaking, as I said, 10% or more correction has about an occurrence about once a year and lasts historically about 112 days. In recent data for the last 30 years, these corrections have actually been a little bit shorter and about 95, 96 days and average about a 15% loss. That's something that's going to come into effect here for the recent correction. So the highs were back in July, about July 28th, and the market correction started, or the official correction hit on October 27th. So that's about 90-ish days. So there is the potential that with seasonality coming up, that this has been it for the correction. This may be the full correction. Time will tell, but we want to give you that just because the markets have been volatile the last 3 months, it doesn't mean that this is necessarily going to continue. This is all in normal market activity. GDP, the good. GDP for quarter 3 came in at an astonishing 4.9%. That is a great number. The economy continues to move forward. All talks of a recession happening in 2023. It seemed like everyone was saying that a recession is going to happen. That has essentially stopped, and the economy continues to be strong. The not so good or the bad here is that the Fed's GDP now forecast out of Atlanta has shifted down for quarter 4. Now, that doesn't mean that, as I said, a recession is here. It just is saying that we'd like to see this continue to grow or be solid. We've shifted from a little bit over 2 to a little bit over 1. So still positive 1+% growth is still good if you extrapolate that over the year. That's still a solid growth for the whole year. It's just that we don't want to see things starting to slide downwards, and that's something we want to keep our eye on. And last, the potential ugly here. Even though GDP has been very solid, historically speaking, growth often is strong right before a recession. So the strong number we've had this year may mean that we're in a new business cycle, or it could be the sign of potential recessions on the horizon. Time will tell, but just because we've had really good numbers, especially a blowout quarter 3, doesn't mean that all signs of recession are gone. The Fed met the other day on November 1st and decided not to hike rates again. This is the second meeting in a row. They didn't hike in September and they didn't hike in November. However, the market has adjusted to the Fed talking about keeping rates higher for longer. So the long-term rate, as we said in the last discussion, has started to increase significantly. We'll wait and see what happens, but it seems like, and the market is reacting positively, that the Fed may be done hiking for this cycle. Jeremy Powell said that they have not discussed a hike and what they're going to do yet. That will be a game time decision in December. But we see here from the Federal Reserve dot plot, it seems like potentially we may have one more hike or be done, and then the market may get a small cut the second half of next year, but the rates will potentially stay higher through 2025. One thing we want you to be aware of as well, for most of the year plus, we've seen the short-term yield move up significantly, and the long-term yield, like the 10-year plus, have kind of been lagging. With the recent information and comments from the Fed in the September meeting, the 10-year and longer end of the curve has increased significantly. And so the inversion that we've been dealing with is very close to uninverting. And as we're seeing the yield curve steepen, something to keep an eye on and something we're going to be watching as well. Now, don't stop believing in the Santa Claus rally. August, September, and October have all been volatile and all been negative. That's something that doesn't happen historically speaking. As you see here, it's only happened a handful of times, but it has been positive. November has been positive for all the previous 6 times, and December has been positive except for once. So there's a high probability that even though the last 3 months have not been fun, the end of the year rally is still on, and we have a strong November and December close for the year. Now, we're not guaranteeing that. We're going to watch, see what happens, but data tells us that potentially November and December should still be pretty positive for the end of this year. Lastly, just something we want to discuss. Could be coincidence, could be something to watch here. But historically, the average year for stocks bottoms on October 27th. That is when the market hit the official correction number, and the next day the market has rallied from then. Now, it could be a rally from extreme oversold positions, and the market is just reacting to that situation, or that could be the fact that the market has kind of bottomed out. We were oversold, and the Fed, with their comments, has alluded to the market, alluded to the rate hikes being done, and the market's reacting positively to that. We're not here to predict what's going to happen. We adjust to what we see, but we want to give you some positive outlook here, that just because the last 3 months have not been very positive and we have hit a correction, again, this is all within normal situations. This is all normal market movements, and that seasonality still could potentially play out here. And with the historical data that with August, September, and October being negative like been, there is a strong possibility that we get positive returns in November and December. We'll continue to watch and adjust the portfolios accordingly. But as always, thank you for watching. And if you have any questions, please reach out to us.